Running any company in Hong Kong in 2026 means operating in a high-velocity, high-density business environment, where even a single, seemingly minor incident can become an expensive dispute or disrupt fundraising, hiring, partnerships, and the organization's ability to operate. Those pressures are amplified for startups because the same error or shock that a larger, established company can absorb may have a disproportionate impact when resources are limited and momentum is everything. That is why startup insurance planning is not about amassing the greatest number of coverages or collecting policies for their own sake. It is about building a practical stack of overlapping protections that safeguards what truly matters: your people, your balance sheet, your ability to keep operating, and the contracts that drive revenue. The most effective approach starts with understanding how your business actually works, then selecting insurance options that align with your risk appetite and your budget without leaving critical gaps. Across industries, startups share a set of characteristics that make insurance decisions feel urgent and confusing at the same time. Many rely heavily on a small leadership team or a single decision maker. Many evolve their business model rapidly, sometimes several times within a year. And many expand their contracting footprint faster than internal controls and oversight can keep up. In Hong Kong, those startup-specific dynamics sit alongside local realities, compact workplaces, an ecosystem of outsourced services, and a commercially sophisticated business culture where vendor onboarding and tender processes often require evidence of insurance protection before a deal can move forward. With so many risks and so many products in the market, the journey can feel daunting. So the right question becomes, what is the first step? If you are a startup starting your insurance journey, the obvious first stop is the coverage required under Hong Kong law. If your company employs any staff in any capacity, regardless of industry, then under the Employees' Compensation Ordinance, employers in Hong Kong must obtain an insurance policy to cover the employer's liability for employees suffering work injuries in the course of their employment. This requirement applies whether the employee is part-time or full-time, permanent or temporary. It is critical to understand that employees' compensation cover is not optional in Hong Kong. Founders sometimes assume that a small headcount or flexible employment arrangements create an exemption. That assumption is false. Failure to obtain the required employees' compensation coverage can expose a business to steep legal penalties. The requirement is universal for employers in Hong Kong, making it the core, foundational insurance product for any company, no matter its size or sector. At the same time, employees' compensation is not a set and forget product. Startup staffing changes quickly, and as your team evolves, it becomes imperative that wages, job descriptions, and headcount declarations remain accurate. Inaccuracies can complicate claims and create compliance issues that no growing company wants to face while trying to hire, deliver, and scale. Once that foundational protection is in place, the next core layer for many Hong Kong startups is public liability insurance. For a wide range of young businesses, the most common early-stage third-party exposure is not a product defect or a complex negligence claim. It is the simple, everyday reality of slip, trip, spill, or drop events that result in bodily injury or damage to someone else's property. In a city like Hong Kong, where meetings happen in shared offices, co-working locations, coffee shops, client premises, and pop-up retail spaces, third-party accidents are not rare. When a claim situation arises, the severity can escalate quickly. Legal representation costs, medical expenses, and the disruption that follows an incident can add up far faster than most founders expect. While public liability insurance is not mandatory under Hong Kong law, it is frequently required by contract. Office rentals are a common example. Landlords, property managers, co-working operators, and event venues often require proof of liability cover before allowing you to occupy or use the space, sometimes specifying minimum limits or particular policy wordings as a condition of access. For a startup planning in-person demonstrations, client workshops, community events, or any situation where customers or third parties come onto your premises, public liability should be viewed as a business facilitator as much as a risk transfer mechanism. The scope must align with how you actually operate, including off-site work, temporary spaces, and any hired or rented equipment that could create additional third-party exposure. Beyond third-party injury and property damage, many modern startups face risk not because of what they manufacture, but because of what they do. Many sell expertise rather than a tangible product. Website design teams, software developers, management and services consultants, accountants, and countless other professionals may not sell a thing, but still carry substantial exposure to allegations of financial loss arising from errors, omissions, negligence, or failure to meet contractual specifications. For startups advising clients or delivering services in any capacity, professional indemnity insurance becomes a central pillar in the risk management stack. Also known in different contexts as professional liability or even malpractice insurance, it can be a critical purchase in Hong Kong's fast-paced B2B environment. It is particularly relevant for tech agencies, fintech service providers, marketing and analytics firms, SaaS teams, and recruiters, because disputes often arise from expectations around performance, timelines, deliverables, or the commercial impact of advice. Professional indemnity products can vary widely, especially in how they treat contractual liability, technology services, and the boundary between professional negligence and cyber-related events. The practical approach is to map your revenue streams and your contract language to the policy's terms, conditions, and retroactive date. That ensures the cover you buy aligns with the work you actually deliver and helps reduce the risk of discovering a gap only after a client alleges loss. From there, a 2026 startup insurance stack needs to take cyber risk seriously. As businesses rely more heavily on cloud systems, payment rails, communications platforms, and third-party digital vendors, digital exposure should be treated as a balance sheet risk. This is especially true for startups, where the ability to operate can depend entirely on systems being available and data being secure. A recent insurance survey of Hong Kong SMEs reported that 11% of businesses experienced cyber events in both 2024 and 2025. That number may not seem high at first glance, but the business impact can be far more severe for smaller organizations that lack redundancy, deep IT resources, or spare cash to absorb downtime and response costs. Cyber insurance in a startup stack typically combines incident response support with business interruption protection. Depending on policy wording, it can cover costs associated with forensic investigations, breach response, notification requirements, and in some cases, ransom or extortion payments. It is also important to be aware that the regulatory environment in Hong Kong is tightening in relation to cyber risk. A new cybersecurity law is scheduled to come into force in 2026, with requirements for risk assessments, independent digital audits, and incident reporting. Even if a startup is outside the scope of the law itself, it may still feel the impact if it provides services to regulated organizations in sectors such as finance, healthcare, or communications, where vendor requirements can effectively push security expectations down the supply chain. Cyber insurance underwriting in 2026 normally expects basic controls to be in place, including multi-factor authentication and resilient backup procedures. For any startup that relies heavily on the internet for day-to-day operations, the value of a cyber policy increases significantly when it is treated as part of a broader incident response framework rather than a standalone purchase that sits unused until a crisis. Alongside digital risk, physical risk remains easy to underestimate, and that is a costly mistake many startups make in Hong Kong. Founders sometimes assume that because they do not own a factory, manufacture goods, or operate a traditional retail footprint, property exposures are minimal. In reality, modern offices can hold a concentrated set of high-value assets that are essential to daily operations. Laptops, printers, coffee machines, microwaves, test devices, demo units, specialized cameras, point-of-sale equipment, and prototypes can represent a significant portion of a young company's assets. If those items are stolen or damaged, including by accidental water damage, the impact can be immediate and, in some cases, catastrophic. Office contents. Insurance is designed to protect the equipment and items in your workspace and can sometimes provide limited support for business interruption events where a covered loss prevents normal operations. While office burglaries are relatively rare in Hong Kong, they do occur, and the financial shock is far worse when there is no protection in place. With the foundations understood, the most straightforward way to build a Hong Kong startup insurance stack in 2026 is to sequence purchases according to 3 priorities: legal compulsion, contractual access, and existential risk. Employees' compensation insurance is typically the first purchase because it becomes a legal requirement as soon as you employ staff. From there, the next step is to analyze how your business operates and map the specific risks you face. Public liability often follows because it supports premises access and addresses day-to-day third-party exposures. Professional indemnity becomes essential as soon as you are in a position where a client can allege negligence or financial loss arising from your services. Cyber insurance should be an early consideration for internet-first businesses because a single cyber event can halt operations, with additional pressure created by tightening cyber expectations in the market. What keeps this approach efficient is ongoing management and internal calibration. Startups move quickly, and waiting for an annual renewal to evaluate emerging risks can leave you exposed during the very period when change is happening fastest. The insurance stack should be reviewed whenever you hire a material or key employee, sign new enterprise contracts, handle sensitive external data, launch a physical product line, or expand internationally. The end goal is a coherent portfolio where every policy has a defined purpose, limits match plausible loss scenarios, and policy wordings reflect how startups are actually operating in Hong Kong in 26. For more information about covering your startup company in Hong Kong, ask CCW, where your insurance is always swift, simple, and sorted.